Okay, hello ladies and gentlemen, and welcome to this webinar brought to you by CITYINDEX. Today we're going to be talking about an introduction to trading the financial markets, how to trade the different financial markets, including the currencies, or FX, indices, commodities, as well as shares. Now this is going to be part of an ongoing educational webinar series that I'm going to be putting on at CITYINDEX, and it's going to be every Wednesday, just like now, right about at 8 o'clock p.m. in London time. So again, this is going to be an ongoing webinar series every Wednesday at 8 p.m. London time, and I'm going to talk a little bit about the upcoming webinars in a moment. But for now, let's just get this started. Again, this is going to be Introduction to Trading the Financial Markets. It's going to be a very basic introduction to start, and then I'm going to get into, in the upcoming weeks, I'm going to be getting into more detailed and more granular subjects. So let's get started real quick. My name is James Chen. I am the Chief Technical Strategist with CITYINDEX Group. And before we get started, just a quick disclaimer, financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay, let's move on. Okay, before I get to just a little bit about myself, for those of you who are not familiar with me or what I do, I just wanted to let you know in terms of the schedule going forward, every Monday we're going to be having an analysis webinar where we talk about the different markets, all of the different analysts at CITYINDEX. This spans between London and Australia, as well as me. I'm here in the U.S. So we're going to be doing that every Monday. We're going to be rotating, giving you different perspectives on the financial markets. And then every Wednesday I'm going to be running this webinar talking about the different educational subjects in terms of trading the financial markets, including trading with indicators, trading with chart patterns, fundamentals, risk management, and all of that good stuff. So that's going to be upcoming every week from now on. So hopefully you look forward to that. And if you have any questions during the course of this webinar or any webinar that we have, please feel free to type them into the questions window, and I would be more than happy to help you as much as I can. Okay, so very quickly about me. I'm just going to do this on the first webinar here. I think a lot of you know who I am. Some of you who don't, just very quickly, again, my name is James Chen. I'm the Chief Technical Strategist at CITYINDEX Group. And what I do is I trade, I analyze, and I educate. So basically, I trade the markets every day, all the different markets. I'm looking for opportunities. So those of you who know me or who have heard me speak before know that I'm not going to be trading all the markets just for the sake of trading. I'm going to be looking at all the different markets, and that spans the currencies, the commodities, the indices, as well as individual stocks and shares. And I'm going to be looking for the best opportunities, and only then will I, look into trading those markets. Okay, so I'm not necessarily trading every market every day. I'm looking for opportunities. I analyze the markets. You can see my analysis on our website at cityindex.co.uk, as well as our other global global websites. And I also educate, much like I'm doing today. Okay, I am a Trading Academy mentor. This is for CITYINDEX that we've been doing in the past couple years. I've been actively trading and analyzing all the different markets for many years, and I use primarily technical analysis, although I do also write about fundamental analysis, but for my trading, I am almost primarily a technical analyst. I am a chartered market technician, which is a designation for technical analysts. I publish daily market analysis that I just mentioned you could find on our website, as well as in different major financial media. And I've appeared regularly on TV giving my views as well as educational pieces regarding trading the markets. I've authored many different articles, and I'm the author of 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets, as well as a DVD set called High Probability Trend Following. Okay, so that's enough about me. Now, just to quickly go over the upcoming schedule. Again, this is an ongoing webinar series. This every Wednesday at 8 o'clock p.m. London time. So, but for the next 8 weeks, we have a schedule for the exact topics I'm going to be talking about. So, hopefully, you could all make it to that. And if you can't, it's going to be it's also going to be recorded, so you could view that at your leisure. Okay, so today we're talking about introduction to trading the different markets, and I'm going to be talking about the advantages and disadvantages and the different characteristics of all the different markets that we look at on a daily basis. This includes the FX markets, the indices, and the commodities and shares. And then next week we're going to be talking about the most useful indicators that I've found that I've been trading with for many, many years. For technical trading, and I'm going to give you a breakdown of what I see as the most useful and how exactly I trade using them in conjunction with all of my other tools. So when I talk about indicators, I'm talking about things like, for example, moving averages, average true range, stochastics, RSI, MACD, and a whole bunch of others. Okay, but I have sort of a handful that I want to talk about, and this is going to happen next week. I'm going to be talking about how exactly I use these indicators and how they help me in conjunction with everything else I do when trading the markets. Okay, so technical indicators are not to be used, or at least I would say they're not to be used as a primary trading tool. Instead, they're going to, they should be used as an adjunct type of trading tool where it could add to your trading toolbox. But I'm going to be talking about this a lot more next week. And then we're going to go into how to interpret the most common chart patterns, which includes the triangles, the head and shoulders, the double tops, triple tops, bottoms, etc. Also the flags and pennants and all that great stuff. So we're going to be talking about that on the third week. And then the fourth week, we're going to be talking about multiple time frame analysis, where you look at different time frames when you're analyzing the charts. And then we're going to go to planning high probability trade entries, how you actually enter into trades. Okay, and then we're going to be talking about exits, setting stop losses and profit targets. And that's going to include, this one is going to include managing your trade while you're in a trade. So not only setting initial stop losses and profit targets, but also managing your trade during the course of a trade. So for example, you can move your stop losses, you can move your profit targets, etc. So you could do a lot during the course of a trade. It's not just about setting your stop losses and your profit targets. And then the week after that, we're going to be talking about emotions and trading psychology. And then the 8th week, we're going to be talking about trading plan discipline. Okay, but again, this is going to be an ongoing webinar series, so it's going to go much more than that. This is just the next 8 weeks of webinars. Okay, so just to give you something to expect and look forward to if you are indeed interested in taking part. So again, every Wednesday at 8 p.m. London time. Okay, so let's get started real quick. And, I have this question from Nima. Where can we find the recorded webinars and watch them? You're going to be able to see them on the same place where you signed up for this webinar, okay? And also yesterday's webinar with Ashraf. I'm sure a lot of you attended that too. And, you could go to that same place, and then you'll see a place, a link to the recording. This will probably go up tomorrow, okay? So tomorrow you'll be able to access the recordings the next day. Now, another thing I wanted to, before I get into how to trade the financial markets, and just a brief introduction to the different markets that I look at on a daily basis, I just wanted to make one thing a little bit clear here. I get a lot of questions asking about making predictions on where the markets go, and we do this every week. Sometimes we hit it, sometimes we don't. But in terms of predictions, I just wanted to make one thing, a little bit clear here, is that in terms of predicting, what I always say when I talk about predictions is that I'd rather I'd rather be a trader than someone who could predict where a market. I'd rather be a successful trader than someone who could predict where the market's going to be at any given moment in the future. Okay, so I don't have a crystal ball, nor do many other people, but nor does anyone. But what we really want to do, and this all boils down to the technical analysis, is that rather than saying, okay, this is where the euro dollar is going to be in a month or in 2 months or in a year. Okay, rather than saying that, I would rather the technical analysis give me triggers, give me ways to get into trades, ways to get out of trades, risk management, that type of thing. So in terms of predictions, technical analysis is much less about predicting where price is going to be. Okay, fundamental analysis is a little bit better at that, but technical analysis is less about predicting where price is going to be, and more about the actual trading, the actual triggers for entering into a trade, the actual triggers for exiting trades, and also about risk management. So that's very, very important to note. So although I do provide predictions every month with CITYINDEX, at the same time, I'd rather that I'm successful trading rather than telling you where price is going to be. And just a note on that. So let's get to how to trade the financial markets. Okay. This is going to be a very brief introduction to trading the financial markets, and then I'm going to go into my charts and show you exactly what I'm looking at on the different opportunities I'm looking at in terms of the currencies, indices, etc. Okay, so there are many major markets to trade and potentially profit from, and I talked about this in my webinar series several months ago, but basically, there are so many different markets to trade and potentially profit from that how do you choose what to trade? Now, that's a great question. So the very simple answer to that is that I look for opportunities. So I'm looking at all these markets, and all I'm looking for are opportunities to trade, whether it be from a technical perspective or a fundamental perspective, but I'm looking mostly from a technical perspective. So I've got all these charts open on my screen, and in terms, I have the Advantage Trader, the Advantage Web, as well as the MetaTrader charts in front of me. I'm constantly searching for opportunities to get triggered into good trades, high probability trades, and opportunities to exit the trades that I'm already in. Okay, so I'm always looking for opportunities. Am I saying, I want to look at only the currencies or only the indices or only these stocks or shares or commodities? No, absolutely not. I'm looking at all of them, and I'm looking for potential opportunities. Okay, so all markets have their strengths and weaknesses, and I'm going to go through those very quickly in a bit. Okay, and some trading strategies work better for certain markets than others, and I'm going to go through that through the course of these different educational webinars for the next several weeks. But basically, I have many trading strategies that I use, many of which I'm going to be presenting in these educational webinars. But as I'm going to show you in just a minute, my main and my primary philosophy remains the same in terms of trading the financial markets, and it's all about trading with the trend. So I'm going to show you a little bit about that in a minute. But in terms of specific strategies, there are many different strategies out there, and some work better for certain markets than others. But in terms of your general philosophy, how you look at the markets, that should remain relatively constant. And I'll talk about what I mean in a second. Okay, so we use the dynamic tools available to us to trade effectively, and there are many tools available, a lot of which I'm going to be showing you next week. Now, one thing to keep in mind, what is long and short? Long simply means to buy, and short means to sell. And they're simply two sides of the same coin. So whereas a long time ago people were, retail traders, individual traders often were all about just going long, just buying a market, buying a stock, buying a share, or buying gold or what have you. Nowadays, and recently, I think a lot more people have gotten into the mindset that the correct mindset that long and short, they're basically the same. Okay, there's some biases. For example, in shares, in stocks and shares, there's some biases, and the bias is usually long in stocks and shares. However, you could go short just as easily as you could go long in most markets, and in currency pairs especially, in indices as well. Okay, if you went short in the indices, in the last couple of years, it might not have been a good idea, but on a longer term basis. But essentially, they're part of the same thing. So long and short, buy or sell. It's the same exact thing. You're looking at a chart. You're looking for opportunities. Okay, so usually what we look for is to buy low, then sell high. Okay, but we could just as easily sell high, then buy low. Okay, which means we sell short first to enter a trade, and then we buy back or cover to exit a trade. Okay, so it's the same exact thing if you think about it. If you buy the euro dollar, okay, and then you sell it when it gets higher, it's the same thing as when you sell it when it's high and you buy it back when it gets lower. Okay, so these are both opportunities where you could either make money or lose money. So let's just keep thinking of it in that manner. Okay, so what we need to do when we trade the financial markets is to create and abide by a strict trading plan. So this is whether you go long or short, whatever your bias is, whatever markets you trade, you want to be able to abide by a strict trading plan. And I'm going to be talking about this within the next several weeks. Okay, so exactly how to put together a trading plan that'll serve you and serve you well, hopefully, in your trading. But you got to do your homework first, and you got to create a trading plan that works according to your experiences trading, etc. So you're going to want to create a trading plan. I'm going to show it to you in a few weeks. Be wary of the pitfalls of trading psychology. I'm going to talk about that as well in the next several weeks. These include fear, greed, and hope, and that type of stuff. I'm going to be talking about that. And what we always want to do is gather as many trading edges as possible. For those of you who have heard me speak before, you'll know I talk a lot about confluence. Okay, confluence is simply a trading edge. Okay, so basically what it is that if you have confluence, basically what you're saying is that you have different factors that you're looking at, different analytical factors that are all pointing in the same direction. Okay, so if one indicator is pointing is pointing short on euro dollar, okay, and also let's say the fundamentals are pointing short. Okay, so it's saying that the euro dollar is going to go down, and then you have other indicators that are saying it's going to go down, etc. If all these are coming together, those are your edges, and so why not put as many edges as you can together, and won't you have a better or a higher probability of having a correct direction in your trade? So what I always talk about is, you want to find confluence in your trading. You want to find as many edges as you can, put them together. If they're all pointing in the right direction, that makes for a higher probability trade. Okay, so risk management is the key overriding principle for successful trading. I cannot emphasize this enough. Risk management is key. And again, as I just mentioned before I started talking about this, technical analysis is all about risk management. It's very hard to set your risk management according to the fundamentals. Not to say that the fundamentals, that I look lower at the fundamentals than I do at the technicals. That's not the case at all. Some people trade almost exclusively on the fundamentals. Others, like me, trade almost exclusively on the technicals. However, in terms of risk management, I would have to say that the technicals, give a much better view or a much better approach to trading than the fundamentals do. Okay, so the technicals give you risk management, exact risk management parameters that you could use to manage your risk, for lack of a better term. So, basically you need to manage your risk. You want to be able to survive to trade another day. And if you don't do that, then you're going to find yourself, in a bad position. So basically risk management is the key overriding principle, and the best way to set your risk management is according to the market and is according to technical analysis. Okay. So that's basically an introduction to how I trade the financial markets. I'm going to be going through the different markets in a second, and then I'm going to be showing you my charts. Before I get to that, though, just a quick review of my principles. And again, what I just mentioned in the beginning of this webinar was that there are many different strategies that you could use for different markets, but it's good if you have a philosophy, a general approach that could dictate all of these strategies. And this is basically it for me, okay? So in terms of entry and exit principles, I'm going to talk about that. And then I'm going to talk about my overriding market principle. And these are what really stays constant when I trade, okay? Whatever market I trade, whatever specific strategy I trade, I'm going to be looking at these different principles, and they're going to remain relatively constant, okay? So the trade entry and exit principles, and I apologize if you've seen this before, but one way to enter a trade is in the right direction at the best possible price. It sounds like it's not really saying anything, right? So, and you could say that it's not really saying anything, but in actuality it is, because one way to enter a trade is in the right direction at the best possible price. Now, what exactly does that mean? Well, the right direction is in the direction of the momentum of the market. What is the momentum of the market? That is the direction of the trend. And do I mean that has to be the direction of the daily trend on the daily chart, or the monthly trend, or the hourly trend? It could be any or either or whatever, okay? That has to do with your specific strategy. The specific strategy you use, the specific time frame you use, whether you use multiple time frames, etc. Okay, but what I'm generally saying here is that you want to trade with the prevailing trend, with the prevailing momentum of the market. Okay. Now, what does the best possible price mean? That essentially means that we're looking for basically pullbacks or dips in the market. Let's say you're trading long on on an uptrend. Let's say in the S&P 500, okay, or the FTSE, the FTSE 100, okay. So these are hitting new highs all the time. Now, do you really want to get in on an uptrend? We're obviously in an uptrend on all these different indices, but do we really want to get in on an uptrend when it's at its high? I would argue not. Okay, I would say yes, you want to get in on a trend, but not when it's at its extreme, okay? So you want to get in at a better price. And what is a better price? It's after there's a dip, after there's a dip in in an index, after there's a pullback, okay? If you have a downtrend, after there's a pullback to the upside, which is called a rally, okay? So whatever it is, we're looking to get into a trend, but we're looking at to get in at a better price, okay? Two ways to exit a trade: at a loss, where the market is telling you you're wrong. Okay, and this is very, very straightforward with technical analysis. You look at a chart, you know where the market is telling you you're wrong. If you get in on a dip, let's say, okay, let's say you buy on a dip in a certain stock. Now, if price subsequently comes down and goes below that dip, then you know that the market is telling you that your original reasoning for getting into the trade was wrong, and therefore that's where your stop loss should be. Okay, if you don't use stop losses, you could get out, that's where you should get out manually, if that's what you choose to do, okay? So whether you use stop losses or not, this is where you should get out, is when the market is telling you that your original rationale for getting to that trade was wrong, and therefore you should be out, okay? No question about it, you got to be out. Now, in terms of profit, of course, which is what we all want, we want it preferably at a multiple of our defined risk. So I'm looking to have my wins outweigh my losses. Why is that? That's because I'm not perfect, far from it, and neither is anyone else. So basically, what we want to do is we want to make sure that even though we're going to lose a lot of our trades, that our winnings outweigh our losses. Okay, so that's why we want our profits preferably on an average basis, preferably to be at a multiple or larger than our defined risk or our stop losses, okay? So that's simply what I mean. So this is a very general trade entry and exit principle that I use for all the different markets. Okay, and then finally, this one, before I get to the different markets, This is the market principle. So I got two general approaches, two general principles that I use. One is what you just saw, the trade entry and exit principles, and this one is my market principle, which is called T.P.B, or trend pullback breakout. Okay, so this is what I'm looking for in any market, in any situation I'm looking at. Again, I have many different strategies that I use, but all of them generally come back to this principle, as well as the previous principle I just talked about, trade entries and exits. So trend pullback breakout, what is it? We're looking for a trend, we're looking for a pullback, we're looking for a breakout that goes back in the direction of the trend. That's all it is, okay? And that breakout would be our trigger to get into the trade. Okay, why am I looking for a trend? I'm looking for the momentum of the market, okay? Again, does it mean I'm looking only at the daily trend? No. If I'm trading on a much shorter time frame, I could be looking at the trend in the past hour, or in the past 3 hours, 4 hours, or what have you. Okay, so this is what I'm looking at. I'm looking at the trend first, and then I'm looking to get in at the best possible price, and that's where the pullback comes in. And then I'm looking for a breakout. Why am I looking for a breakout? Well, this breakout is showing me that short-term momentum is agreeing with a longer-term trend, and therefore I want to get in. Look, I'm looking for edges in my trading. So this breakout is showing me that short-term momentum is agreeing with the longer-term trend after the pullback, and therefore I'm gathering my edges. Okay, so this is everything's telling me it's going up. Okay, so we got the past momentum. We've got the pullback, we've got the recovery of the pullback, and a breakout in the direction of the trend, and therefore that is giving me some indication that this is a rather high probability trade, and I may take it if everything works out correctly. So here is my risk. Once you have this breakout, you have your risk. This is this red line right here is where I place my stop loss, or where I want to get out manually if I choose to do so. And once you have those two levels, the entry and the exit, and the loss exit, there you have your defined risk, okay? And then from there you could define your reward. So this goes back to my previous approach just now, where I talked about the entry and exit principles, okay? So the loss is where the market tells you you're wrong, and the profit is preferably in a multiple of your defined risk, and that's it right there. Okay, so trend, pullback, breakout. Okay, here's just on a real chart here. I've got the trend, I got the pullback. The pullback goes back to this uptrend line. It also goes back to this moving average. Okay, and then I have a breakout above this counter trend resistance line. That's my trigger to get into that trade after the pullback. Where do I place my risk management? Where do I get out of the trade if there's a loss? I get out right under the low of that pullback. That's the market telling me I'm wrong. If it continues, I'm looking to get at least as much as my risk. I'm looking to profit by at least as much as my risk. In this case, this is about 2 times it. So that's even better. Okay. Question, Kevin, how do you decide on the time frame, minute, hour, or daily trend? Okay, I'm going to be talking, Kevin, great question. I'm going to be talking a lot about this in the next few weeks. I'm not talking about the exact entries and exits and what I'm looking at in this particular webinar, but I will get to that. Rest assured. I'm going to be looking mostly at daily charts today. Okay, but when I do trade, I usually look for not just the daily charts, but I'm drilling down into the hourly charts and sometimes even below that. So I know a lot of you may be short-term traders, and that's great. But in terms of choosing the time frame, it really depends on what kind of trader you are. A very short-term trader, you want to be a day trader, or do you want to be a swing trader, or do you want to be a longer-term position trader? Okay, so that's really up to your style of trading. Now, that being said, all of the principles that I'm talking about today and in the next weeks, several weeks, all of that can work on all the different time frames. Okay, so whether you whatever indicators you're looking at, chart patterns, the trend, breakouts, pullbacks, etc., these work on all the different time frames. Okay. Okay, so let's move forward real quick. Okay, so I'm going to go through the different markets real quick, and then I'm going to show you some charts. Currencies. First, this is more for those of you who are beginners, but we have to start somewhere. Okay, we have to start, somewhere, giving you an introduction to the different markets before I start getting into the more granular type of trading methodologies and strategies that I use. And this is going to start next week. Okay, so right now I'm just giving you an overview of the different markets and how I look at them. So basically, the currencies. We have the different currency pairs. The major ones include the euro dollar, pound dollar, dollar yen, Aussie dollar, dollar Swiss, etc. So if we take a look here, we could see that there are two different currencies in these currency pairs, and basically what that means is that you have two currencies pitted against each other. Okay, so the euro against the U.S. dollar, the pound against the U.S. dollar, the euro against the pound, okay, and what have you. So that's how currencies are quoted. Now, what do we look for when we're trading the currencies? Well, basically, from a fundamental perspective, we're looking for, at the global macroeconomic factors, interest rates, inflation, central bank activities, monetary policy, global risk sentiment. I know it's a mouthful, but basically, you're looking at pretty much everything on a macro basis. So, whatever happens in terms of the global economies, even political events, global risk, interest rates, inflation, etc. All of this plays into the fundamentals of looking at currencies. It's a lot to look at, okay? So I do keep in mind the fundamentals, but again, from a day-to-day trading perspective, I'm using primarily technical analysis. So what are the technicals? Trend, support and resistance, moving averages, relative strength and weakness, indicators, chart patterns, etc. This is a lot of what I'm going to be going through, in the next several weeks. But basically, okay, so I mean, just to give a side note here, when I write about, I often write about fundamentals as well as technicals, but I often write about fundamentals, although I don't usually use them so much in my day-to-day trading. I do write about them. But whenever I write about different markets, I'm going to be writing about, a ton of different things, and they're completely different whether you're talking about currencies or individual shares or commodities or indices. They're all pretty much different. The fundamentals are all pretty much different, okay? But in terms of the technicals, they're all pretty much the same thing, okay? We're always looking at the trend. We're looking at support and resistance levels. We're looking at, the different indicators. We're looking at chart patterns. That's what we're looking at. Fibonacci levels. Okay. If you don't know what these mean, I'm going to be talking a lot about this again in the next several weeks. But basically, we're looking at the same things, the same factors on the technicals for all the different markets. Whereas on the fundamentals, they're completely different. Okay. For the most part, they're completely different. Okay. So on the currencies, the general directional bias, there is none, okay? It's going to be long or short, okay? So if the euro dollar goes up, that means the euro went up against the US dollar, or the US dollar went down against the euro, okay? If the euro dollar pair goes down, that means the euro went down against the US dollar. It also means the US dollar went up against the euro, okay? If that seems confusing, it can be in the beginning, but it's just something you need to learn. So again, if the euro dollar goes up, the euro went up, the dollar went down. If the euro dollar goes down, the euro went down, the dollar went up. Okay, so there is no general directional bias. A lot of people say, for example, I want to buy this stock. Okay, let's say Apple. Okay, so if I bought Apple a long time ago, I would be rich now. Now, in terms of the currencies, though, the currencies have no bias like that. Okay, so the euro, there's no I want to buy into the euro dollar because I want to take care of my grandchildren with buying the euro dollar. No, it doesn't work like that. For the currencies, there is no directional bias. It could go up or down according to the different fundamentals of those different global markets. Okay, so again, directional bias, there is none. Long or short, either way, it's the same thing. Okay, you're looking for opportunities. The speculative characteristics of currencies. We're looking for relative macroeconomic performance, central bank activity. Okay, the strengths of trading the currency markets. there are well-known market-moving events and announcements. Okay, so for example, we have the non-farm payrolls for the U.S. dollar that came out. That comes out in the beginning of every month. Okay, the first Friday of every month. And for example, just from the U.S. perspective, because I am in the U.S., for example, we just came out with the Fed announcement. Okay, and that moved the dollar somewhat as well. So those are well-known market-moving events and announcements that we could count on, and that we could actually look at to to move the markets. Now, another strength of the currencies is that they tend to trend for prolonged periods. Okay, so all you have to do is look at any chart. Okay, you look at euro dollar I have here, and you could see this trend has been remarkable. Okay, and I'm looking for it to continue personally. Okay, but again, I'm not going to predict. I made this prediction that I think it's going to go down. But that's not really what I do. I want to be more useful to myself as a trader and to other people as a trader, rather than saying, this is where the euro dollar is going to be. That being said, I did put a prediction in for March that the euro dollar is going to go down. But in any case, if we take a look here, we could see that these trends are just remarkable, and they could all be taken advantage of. So you take a look at euro dollar, you take a look at pound dollar, although there has been a big upside move on euro dollar. Take a look at dollar yen, at Aussie dollar. I mean, this has just been remarkable in terms of the trends. So again, the trends on these are you could take advantage of these trends, a lot. They're all over the currency markets. Another strength is no longer short bias. Okay, so there's none of this. I want to buy and I want to hold it for a long time. No, it's long or short. You look for the opportunities. Reliance on relative strength and weakness against other currencies. That's a good thing. Okay, so we're not just trading the euro. We're trading the euro as it relates to the U.S. dollar. And there are a handful of major tradable instruments. This could be a good thing or a bad thing. In terms of there are only a few tradable instruments that are really worth trading in the currency markets, and these would probably be the majors and some of the major crosses. The majors being euro dollar, dollar yen, Aussie dollar. I'm sorry, euro dollar, dollar yen, pound dollar, and dollar Swiss, as well as some would say Aussie dollar and dollar Canada. Okay, and then some of the crosses include euro pound, euro yen. Pound yen, those type of things. So it's only a very small handful of tradable instruments. So this could be a good thing or a bad thing. So in terms of being a good thing, you don't have a lot that you need to pay attention to. Okay. In terms of being a bad thing, you don't have a lot in terms of being diversified. Okay. So lower correlation with equity markets, that's a good thing, because a lot of people trade the equity markets, and sometimes they want a non-correlated entity to trade, and this would oftentimes be the currencies. The weaknesses, limited number of trading instruments. Like I said, this is both a strength or a weakness. Lack of diversification. Major currency pairs, the ones I just mentioned, they all trade against the U.S. dollar. Do you really want to be tied so closely to the U.S. dollar? Increased volatility due to sensitivity to global events and central bank stances. Okay, so that's currencies. Let's talk about indices. Examples include the FTSE, S&P 500, the Dow, Nikkei, NASDAQ, and many more, and also the German DAX, which as of late has been very, very bullish. Okay, so the fundamentals we look at are overall equity outlook, macro factors, interest rates, global events and conditions, sector performance. The technicals are the same thing: trend, support, and resistance, moving averages. The general directional bias, though, for indices is long. Okay, I mean, some would argue with me on that, but generally speaking, for all equity-based markets, you're usually looking at a long bias. Okay, so stocks are generally biased towards the long side. Same with indices. Although that's not to say that these can't go down. Of course they could go down, but the general bias is to the upside on the indices, whereas it's not for the currencies and commodities. Okay. Speculative characteristics, overall, we're looking for overall equity market performance. The strengths of trading indices, built-in diversification. Okay, so you look at the FTSE, it has 100 different major shares in the UK market. S&P 500 is 500, so it's built-in diversification in that respect. Okay, solid returns in recent years. Okay, the last 6 years, at least in the U.S. indices, have seen remarkable returns. Relatively lower overall volatility because of diversification. Let's say you're trading a stock. Okay, the stock can move wildly, whereas the index that the stock belongs to will move a lot less wildly because of the fact that it's smoothed out and it's diversified across a basket of different equities. Okay, so indices are a primary barometer of financial and economic environment. It's the traditional method for investing. It's a traditional method for investing in the market, and it greatly diminishes the need for research as opposed to individual shares. Okay, so if you are trading individual shares, you're going to need to research those shares if you want to do well. Okay, if you're a day trader, maybe not so much, but if you are even a slightly bit longer term trader, you're going to want to know a little bit about the company that you're trading, okay? Whereas in terms of the indices, not so much, okay? So the indices, you don't have to do as much research. Although we are looking at the overall equity outlook, the overall macro factors, in terms of the micro research that you have to do when you're trading stocks, you don't really need to do that. Weaknesses, lack of choices, choosing specific investments. Also, there's a handful of indices that you could trade. Okay, that could be a good thing or a bad thing. It's a more passive form of trading, and it's high vulnerability to overall market risk. Okay, commodities. Examples, gold, silver, crude oil, natural gas, etc. Okay, so the big story here, of course, has been crude oil. Whether you look at the Brent crude oil, which is the global benchmark, or you look at the U.S. benchmark, which is West Texas Intermediate, WTI, the oil market has been incredibly depressed and pressured to the downside. Okay, gold too. But in terms of the fundamentals, what do we look at? Now this is different from indices. It's different from currencies. It's different from shares. What we're looking at is supply and demand, most of all. Okay, we're also looking at global macro factors and global risk sentiment, but mostly we are looking at supply and demand. In terms of commodities, it comes mostly down to supply and demand. Now, in terms of, it also does in other markets as well, but more so in the commodities. So, for example, why is oil so low? Well, it's very simple. The supply has increased, and the demand has decreased. Okay, so that's why we're seeing this big plummet in oil. That's the basic explanation for why oil is going so low. So we have the Middle Eastern countries, not cutting their oil output. You have the U.S. not cutting its. Well, they're starting to be forced to cut their oil output, but still, with the fracking, I don't know if you know what's going on in the U.S., but fracking or fracturing is looking for oil in the U.S., and the production has been remarkable in the last several years, and therefore there's been a glut in the oil supply. So you've got an oversupply in oil between the Middle East and then the U.S. and other countries, and the reluctance to cut back production, and therefore an oversupply. And then you also have waning demand, including from such places as China. So you have all these fundamentals coming together in terms of supply and demand, and you see that oil is low and could even be going lower. Okay, so those are the fundamentals we look at. In terms of technicals, same thing. Okay, however, in terms of the technicals, for me, they're not as useful in the commodities as they may be in the currencies and the indices and the individual shares. Okay, so in terms of commodities, not as useful, but still useful. We take a look at gold, and we see that the support is at 1180 and was hit 3 times. Let's take a look right here. So we look at gold, okay, and we look at this 1180 level right here. Okay, so this was back in mid-2013. This is 1180. This is back in January of 2014, and then once again we had it back in October 2014. So these are technical. That's a support level. That's an extremely strong support level before it was broken to the downside. But is that a coincidence? I mean, those are the technicals working right there. 1180 being the price right there. Okay, and I have it again. I wrote about this today. I have 1180 still as support. So I'm looking for a bottoming out of oil, and it's very near its multi-year lows. Anyway, let's go back here. So that being said, the technicals do work on commodities, but for me, not as much so. General directional bias could be long or short. Okay, there is no general long bias on commodities. What are the speculative characteristics? Again, individual commodity supply and demand. The strengths are that markets move on supply and demand, outlook and sentiment, and are highly dependent on known macro variables. They're the traditional markets for active speculators. So if you are an active speculator, chances are that you're trading gold or silver or oil or what have you. Okay, and it usually moves in sustained. It often moves in sustained trends, as we see on oil and gold. Weaknesses: potential for elevated risk and higher volatility, and we've seen that very much so lately, and lack of diversification options. Okay, so finally moving on to individual shares or stocks. Examples include Apple, Microsoft, Barclays, Vodafone, IBM, many others. Okay, there's just literally a huge universe that you could trade with us when you trade shares. Okay, if you want to trade shares, and there are a ton of them out there. And in terms of the fundamentals, a lot of stuff you got to look at if you want to trade this from any, if you want to trade this from a point of knowledge and being prepared, then you should know your fundamentals, which include the balance sheet, earnings, the management team, the products and services, their market share, mergers, acquisitions that may be coming up, the price-earnings ratio, revenue outlook. It's a lot to know, okay? But again, we get back to the technicals, and they're basically the same thing. We're looking for trend. We're looking for support resistance. In this case, we're looking for oftentimes the 52-week high-low range, because oftentimes we'll see price action move up when it reaches a 50, or when it establishes a 52-week low, or when it's near it, and move down when it's near a 52-week high. Okay, for those of you who are range traders. As well as moving averages, etc. So the technicals are essentially the same thing. General directional bias on shares, long. Okay, so again, this doesn't mean that shares and stocks don't go down. It simply means that people generally buy into stocks. Okay, they want to own the stock. It's something that you own. Okay, whereas with for example the currencies. If you're a speculator in currencies, you're not really looking to own it. You're looking to capitalize on the short-term price movement. Okay. Nima asks, are indices more suited for day trading due to the fact they are less volatile? All I could say is I don't know if they're more suited for day trading. I'm not a day trader, Nima, but I can't say it's more suited for day trading than other markets. But a lot of people day trade indices. Yes. Okay. A lot of people day trade indices and currencies as well as stocks and commodities. So whether to say one is better than the other in day trading, it's very hard to say. But that being said, I know of several really good traders that what they do is all they trade is the S&P 500. Okay. The S&P 500, what are called E-minis. Okay, so the mini contract for the futures contract for the S&P 500, which is the U.S. benchmark index, or one of the U.S. benchmark indices. So all they do is trade that, and they do remarkably well at it. So, yes, I mean there are a lot of people trading indices on a day trading basis. Okay, so speculative characteristics we're looking at. For shares and stocks are individual company performance and company future prospects. And the strength of trading shares is that it's a traditional method of wealth creation and growth. How many people have you heard tell you that they bought this particular stock or share 10 years ago, and now they're extremely wealthy. Okay, I mean, it happens all the time. Potential for sizable returns on high-quality companies, and also it can be a more active form of trading. Okay, so there are a lot of day traders that are trading stocks as well. Okay, and they're trading earnings reports and all that great stuff. Weaknesses: need for diversification. If you're going to be trading, you should be if you're going to be trading stocks, individual stocks, you should be trading a basket of them. Okay, to sort of diversify. Because, for example, if you're trading only technology stocks, what if the whole technology sector, as it's done many times before, suddenly plummets? Okay, then you've got all these holdings in all these technology stocks that just completely ruined your day or your week or your month or what have you. Okay, so you want to be able to diversify if you are trading individual stocks. High potential for earnings and event-driven volatility, and there's added vulnerability to market risk. Greater need for broad-based research. Okay. Okay, let's move forward real quick. So those are the different strengths, weaknesses, and characteristics of the different markets. Let's go to the charts and just take a quick look at what we're looking at here. Let's take a look. Okay, so I'm just going to go through very quickly what I'm looking at from a technical perspective on the different currency pairs before I wrap this up. Now, what I talked about on the euro dollar, we take a look here, very, very steep. You know, this curve to the downside, very steep downtrend. We've had here. I have the 50-day moving average. Let's take a look here. 50-day moving average, just following price action very closely. It's acting as resistance. You know, the beginning of this year, let's take a look. Beginning of this year, we saw a gap to the downside, a breakdown below 120.40, a further break, hitting all of my targets, okay, all of my targets, including the last target being 111 to the downside. It just hit it. Let's take a look on here. It just hit it just under 111, which was my target, okay? 114 was my target as well, as was 116.40. All the way coming down. So we had all these targets being hit on this remarkable downtrend, and I'm looking for further. Okay, so right now we are in a consolidation here. You could call this a triangle consolidation or pennant or whatever you want to call it. Okay, right now we're in a consolidation, and we have been ever since we rebounded from this 111 low. Okay, so price action hit this 111 low, which was my target, support target, and then it came back up to the upside, and it did a sideways move, and it has been doing so ever since. Now, this is called a classic consolidation, okay? Now, what I'm looking for is a break of this consolidation to the downside, okay? So, again, trend, pullback, breakout, okay? Trend, pullback, breakout. There are some questions there. I'm going to go over those in a second. So, trend, pullback, breakout. So, right now, what we have is trend. We have pullback. I'm looking for a breakout or breakdown to the downside to continue this this downtrend. Now, again, right now we are in a consolidation. I am looking to target 111, and if you look at my prediction for March, that hasn't come out yet. It will come out very soon, but I'm looking for 111. Okay, and I may very well be wrong about this, but as I have many times before. But I'm looking for 111. And then 108, okay? It doesn't matter if I'm right or wrong. What I'm looking for is the trigger to get into the trade. If I'm wrong, I have my risk management to take care of me, okay? So I'm looking for 111 to the downside is to retest that low, and then from there, if there's a breakdown and a continuation of this downtrend, I'm looking towards 108. Okay, 108 to the downside. These are strong support levels. So I'm looking further for a further continuation of the downtrend. Let's take a look at pound dollar. Okay, now I did not anticipate this this big move to the upside. My colleague Ashraf did anticipate it though, and he's looking for a lot more upside from here. For me, I'm looking at this as a very strong downtrend. Okay, and until it hit below the 150 support level, it hit 149.50, which was like a it was a multi-year, I believe it's a multi-year support, multi-year low Let me see. Last time was 2013. Okay, so a little bit more than a year. So we have this low here, and then price action rebounded. Okay, and then I have this downtrend resistance line. I also have the very strong 50-day moving average here. It was broken to the upside. Okay, and that break to the upside was a hint that something was further might be coming in terms of this rebound. And then it hit 154 to the upside. That was my resistance. Okay, and then it went further above there. Okay, so I'm looking for a continuation down to the downside. The next major resistance to the upside is 157.50. But generally speaking, on a longer-term basis, I'm looking to the downside. Okay, on pound dollar. Let me see. Lua says, I'm sorry, Adadapo, are we going to get this slide sent to our email box at the end of the session? This is going to be recorded, so you could. This is going to be recorded and posted tomorrow, so you should be able to get it straight from our website. And is it smarter to buy at a support level or points where the candlesticks are just starting to be above the moving average? Is it smarter to buy at a support level or points where the candlesticks are just starting to be above the moving average? I'm not exactly sure what that means, but I think, yeah, oftentimes we look to buy at support. So, I mean, that's, yeah, I mean, in terms of the moving average, I don't really use moving averages other than as directional indicators for the trend. But support and resistance, I absolutely use. So if you're saying if you buy at support, yeah, oftentimes you will. I will buy at support and sell at resistance. Okay, so we see this up move on pound dollar. And then once again, I have very strong resistance up here at 157.50, but I am looking for a retreat on this move to the upside and a further move back down towards the 150 level on pound dollar, and possibly to continue this downtrend on this currency pair. Dollar yen has been doing a whole lot of nothing lately. We take a look here, also in consolidation. The theme for the last couple of weeks on all the currency pairs has been consolidation. So if you haven't found opportunities to trade in the currency pairs, you're not alone. Okay, there has been a lot of consolidation, whereas the indices have shown much more buoyancy, if you will, or volatility. The indices have been moving relatively much higher relative to the currencies. So in terms of the currencies, yeah, I mean, a lot of consolidation here. I had this triangle pattern here. It broke to the upside. It hit my target up here at 120. I'm looking for 122. Okay, but all it does is consolidate, and we've got this triangle pattern. It broke to the upside, hit 120, and we're still in a consolidation. Okay, so I'm looking for further upside once and if the dollar continues to strengthen as it has, and as it has halted in the past couple days and weeks. Aussie dollar, this is a very interesting one. If you take a look at this very strong downtrend, it hit a multi-year low down here below my 77 target. Okay, so 77 was my target. Next target to the downside is 75. Today we saw a move to the upside, but I'm pretty confident it's going to move lower. And if there's a breakdown below 77 support again, I'm looking towards 75 and then eventually towards 73 as my next major target to the downside. But this is a very strong downtrend, and Aussie dollar is showing a lot of bearish pressure. Pressure to the downside. So again, we're near the multi-year lows, looking, down below 77. Again, trend, pullback, and then I'm looking for a breakout. Okay, just like on dollar yen, what I just showed you, trend, pullback, breakout. Okay, that's exactly what I'm looking for. Same in Aussie dollar. Now, gold is a bit different. Okay, so let's take a look at gold real quick. We have this triangle pattern. It broke to the upside. I was fully expecting, I was predicting and looking for it at least to hit the 1325 level, resistance level or so. It comes short of that, okay? So it comes short of that and then falls precipitously. And now we're back near our strong support at 1180, okay? So again, this prediction of where it might go, it doesn't always work out. But what you want to do is you want to be able to trigger yourself into trades. So right now there's not much of a trend on gold. I am looking for a rebound back to the upside, seeing as how we're near very strong support at 1180, and also near very strong lows near 1130. Okay, this was the multi-year low at 1130, so I'm looking for a rebound to the upside. I have been looking for a rebound for quite some time. Okay. Okay, so the question here, I've heard so much about triangle pattern. Can you briefly say what it means? A triangle pattern. Okay, great question here. This is a triangle pattern. Okay, basically what it is a consolidation. Price action goes, up, down, up, down, up. You see triangles all over the place. Okay, here's a triangle. Here's a triangle. Okay, all you're looking for with a triangle is you're looking for a break. I'm going to be talking about this a lot in the next 2 weeks, or 2 weeks from now when I talk about chart patterns. Okay, so we're looking for breaks. Breaks of consolidation. We're looking for low volatility to move into high volatility. Okay, low volatility move into high volatility. That's exactly what a triangle is. Okay, so dollar yen. Okay, so there was a break here of this particular triangle. Okay, but it didn't really pan out as of yet. Okay, now this was a triangle too back here. This was a really long triangle back here. It was a big consolidation on dollar yen. Okay, and then it finally broke out. It broke out, and then it continued, a lot. There's a triangle right here, too. If you take a look here on dollar yen, triangle is simply, the lines are converging. That's what makes the triangle, okay? So it converges and then breaks out, okay? The breakout, it could break out to the upside or to the downside, depending on where the trend is and depending on where price goes. But for here, basically, we look at triangles as continuation patterns, okay? So we're looking for continuation patterns. Here I'm looking for continuation to the upside. Again, a triangle just epitomizes the trend pullback breakout philosophy, okay? So trend pullback breakout, okay? This happened to be a fake breakout, but that's what we're looking for, okay? Trend pullback breakout. Okay, so gold, back to gold. So this, very much a consolidation here. A pullback to the downside. Overall, still near the lows. I'm looking for a move back to the upside. Let's quickly look at some others before I wrap this up. Okay, let's look at oil. Okay, so we take a look at oil. This is U.S. oil. Okay. This is U.S. oil, which is a reflection of the WTI benchmark, the West Texas Intermediate benchmark. Okay, look at this right here. Now, you take a look here. We hit a low near 43, okay? We have very strong support at 35. So I talked about possibly it going below 43. If it went below 43, then possibly towards the 35 level, which would be ridiculously low. And I don't want this to happen, okay? But that support there, we got support at 43. Right now we're consolidating. I'm hoping or looking for a breakout above 55 resistance, in which case we could be seeing a bottoming out. At this point, a lot of people talk about potential bottoming out here. Okay, this pattern right here. It didn't really happen as of yet. Okay, so I would look more towards a breakout above 55 resistance, and then that would look to me more like a bottoming out pattern and a possible partial recovery in oil. I don't think we're going to get near where we were at just last year. Okay, I don't think we're going to get even near that, but I do think that there could be a bottoming out and a potential move up towards the 60 level at least if there's a breakout above 55. Okay, on a shorter term basis, but essentially speaking. Yeah. So, but still, very strong trend, downtrend on crude oil, and then finally, not much to say here on the FTSE 100, other than that, it just it's sort of consolidating right around where strong resistance is. So if you take a look at this, how much stronger resistance can you get than this? Right here, okay, on the UK 100. This is a daily chart. So price action popped up a little above that. Now it's right around there. It's right around the 6,900 level. 6,900 level on FTSE is extremely strong resistance, as we can see just looking at this chart, okay? This is all technicals right here in terms of the resistance, okay? And then, S&P 500 broke to new highs as did the Dow, looking possibly for 19,000 on the Dow or Wall Street. But I am looking for a pullback on that, as I am looking for a pullback on all of the indices. They've just gone too far, too fast, too high. As we can see here, I am looking for a pullback to the downside. But in terms of S&P 2200 is a further upside target, but again, looking for some downside movement. Okay, so that's about it for this installment of the educational webinars. Again, this was basically just an introduction. I'm going to be talking about a lot more in the coming weeks, so please feel free to to come by and attend those webinars. And if not, you've got the recordings. And again, this recording will be put up by tomorrow, so hopefully you could all take a look at that as well. And until next time, until next Wednesday, I'd like to thank all of you for your time today. Thank you very much.